Hello everyone. So in the continuation of discussing about various accounting concepts, today we're discussing about another concept which is a very important concept in accounting, which is called as a matching concept. Now previous to this concept, we have discussed in the previous session on a concept which is called as accounting period concept. So in the previous session, we have discussed accounting period concept, where if we recap, what we have discussed is that before we start preparing a book of account or we start preparing income statement, it is imperative that we first define the period. You first define the period. The period theoretically it can be a day also, but normally the periods are generally a quarter, a half year, or an annual. So you first define a period. So let's assume in normal circumstances, if a company takes a calendar year, which is from 1st January 2021 to 31st December 2021 as their defined period, and which means they want to estimate the profit and loss for this particular period. Now, once the period is defined, then the concept of matching concepts come into picture. What does it mean? That means I will have to match the revenue earned only during this period, which is, and only the revenue, if I first estimate the revenue which is earned during this period, I will also estimate the expenses which are incurred only during this period. And once we find the difference between revenue and expenses, I will then get what is referred as my profit and loss. Now, things you might be thinking, it's fine, that's very simple. No, we need to do certain adjustments because in business, as we've discussed it before, that business is a continuous process. There are transactions which are happening on the frequent basis. But I have to segregate as an accountant when we are preparing the books of account or when we are preparing the income statement that I only need to know the revenue for this particular period which we have defined and only match with the expenses for this particular period. And this also takes into consideration another important principle which is also referred as an accrual basis of accounting. So in this session, we are taking two concepts simultaneously because both the concepts are linked together. And only then we were able to understand both this concept in totality. So there are transactions which are happening in the business where even though the cash has not been paid, but the service has been rendered or the goods have been delivered. So let's take an example to understand this entire concept in both these concepts in totality. So for that, let's assume a company ABC is preparing a books of accounts and they have taken period 1st January 2021 till 31st December 2021 as their accounting period. So this has been defined as an accounting period. Once an accounting period is defined, as per matching principle, I have to match the revenue for this period only. I have to find the expense only for this period, and once I adjust it, I will get, if revenue is more than the expense, I should get profit, or otherwise I should get loss. Now, what may happen in this? It may happen that, for example, let's assume this ABC Limited is a trading company. Now, it may happen that some goods might have been delivered in the month of December. It's on 30th December. So, and we'll keep on discussing this transaction in future videos also, but just for understanding purpose, on 30th December, goods worth rupees, let's assume 50,000 have been delivered. These goods have been delivered. Now, however, the cash is still not received. Now, we have two types of accounting. One is called accrual accounting and the cash accounting. In normally across the globe, it is accrual accounting is followed. That means even though, and this is where the accrual concept comes, even though cash has not been received till now, but since the good has been delivered, the ownership of the goods have been transferred to the buyer. Whether the buyer has paid cash or not paid cash, this 50,000 rupees, since the transaction happened on 30th December, it will be counted as a revenue for this period. So, even though, and this is where the accrual principle comes, the goods have been delivered, the ownership of the goods have been transferred to the buyer, even though the cash has not been received, it will be counted as a revenue for this period. Similarly, Let's assume this business has been, we are doing this business in a rented premises, and the December rent, the month of December rent, let's assume December rent is let's say rupees 10,000. This rent was not paid by 31st December, but the business has utilized the services. Since the business has utilized the services, the business has utilized the premises, the usage of premises has been done, the usage of these services has been accrued, even though the payment of the rent was not done, this will be counted as an expense for this period only. So now you can understand the linkages between three principles. One is accounting period principle, the other is a matching principle, and the third is an accrual principle. So these three principles, accounting period, which we have discussed in the previous session, then matching principle, I have to match the revenue for this period with the expense incurred in this period only, and the accrual principle, right? So these are, in this transaction we have seen all the three principles are working in totality. Let me take another example. For example, some buyer has made the payment. So let's say ABC Limited is in the garment business. So the buyer has made payment and the payment has been received by 30th December. So let's assume there's a buyer XYZ Limited. He's a buyer and he has paid rupees 50,000 to this company, and this was received on 30th December. Now, the goods have still not been delivered. So 30th December, the cash has been received by the company. The goods have not been delivered. Now the question is, will this 50,000 rupees which has been received by the company, acknowledged by the company that yes, the cash has been received, or in the bank the amount has been received, can I call this as my sales or revenue for this period? Unfortunately, no. This is not counted as revenue for this period. Why? Because by till 31st December, which was an accounting period, goods were not delivered to the buyer. The ownership of the goods were not delivered for this buyer. And therefore, this 50,000 will not be counted as a revenue for this particular period. Possibly the goods will be delivered maybe in the month of January, in the coming January 2022. So let's assume there's a January 22 coming, which is here, and the goods are delivered in this period. Therefore, the sales will be counted in the next accounting period. This sales will not be recorded for this particular period. And technically, we'll see later on, this is also called as advance revenue received. Well, let's take another example. I'll take another example to explain that. Let's assume, again, let's assume the same accounting period, that is 1st January 2021 till 31st December 2021. Let me take another example. The example is that in the month of December, so in the month of December, the company which is ABC Limited, so I'm taking example ABC Limited, the month of December, the company has paid 2-month rent. They have paid 2 months rent, and at a rate of rupees 10,000 per month. So the company has paid rupees 20,000, right? But my accounting period is only from 1st January to 31st December. The rent which has been paid actually is 20,000 rupees. But which means I have used till 31st December services only for 1 month. The rent which I have paid for 2 months even though, but services has been used only for 1 month. Therefore, for this period for ending December 2021, the entire rent will not be taken as an expense, only for 1 month. Only for 1 month, which is for the month of December, which is 10,000 rupees will be treated as an expense for this period. So 10,000 rupees will be treated as expense, and remaining 10,000 I'll use this expense, I'll use this service in the next accounting period. And technically we'll see that this will be an asset in the business organization. But what we're trying to understand this, we're trying to match the income and the expenses, and also we are trying to understand the accrual principle. So accrual principle says that it basically means that even though the money has been paid or received, even though has been paid or received, it doesn't mean, but if the revenue has been recognized, even though the cash has not been received, but since these services have been rendered, the goods have been delivered, the revenue will be counted. If the services has been acquired, expense will be counted, even though the payment has been made or not. And this is what is called as an accrual concept. So in accrual concept, it is very important. As I mentioned, this is in connection with the remaining two concept, which is first the matching concept. So matching concept means you have to match the revenue for that particular period with the expense for that particular period. So let me give you one more example to give you explanation. Let's assume that the sales, again the same example, that is let's say the accounting period as 1st January 2021 to 31st December 2021, right? So revenue for this, the sales for this period is, I'm assuming the sales as, let's say, rupees 100,000. So 100,000 sales have happened. Now expenses for the same period, I'm saying as rupees 60,000. Now when I analyze the expenses, I saw that in the expenses there is an expense which include, let's assume, a salary which has been paid, and the salary has been paid in advance. Salary has been paid in advance for the month of January, right? And that salary amount is, let's assume, which is paid in advance, is rupees 5,000. Now this salary which has been paid in advance for the month of January has been included in this expense. So what is happening here is, the sales is for a period which is January to December, but expenses, there is an expense in this expense which is actually for the next period, and therefore this is not matching. I have to match this. So what will I do now? I will subtract 5,000 from the expenses. So my sales actually is 100,000. So sales is taken as 100,000, but expense will be taken only at 55,000, and my profit will be 45,000, which means this 5,000 rupees expense which has been paid, it actually is not for this period, and therefore it will not be shown as an expense for this particular period for estimating the right profit and loss. So I hope you are able to understand and bring a connection between three concepts: accounting period concept, which we discussed in the previous session, and also the accrual concept. These three concepts are interlinkages. As I mentioned, accounting we prepare on the basis of accrual concept. There is a concept of cash accounting also, but across the globe we always followed accrual accounting. We do not follow cash accounting. In cash accounting, generally what is presumed that we will record the transaction only and when the cash has happened, or when the cash has been received or cash has been paid. But this is not the accounting standards across the globes are following it. Accounting standards, accounting nomenclature which has been there across the globe follow the accrual concept, which means that if the goods have been delivered, if the service has been rendered, then the revenue is supposed to be accrued. If the service has been acquired, if the goods has already been purchased, even though the payment has been made or not been made, it is assumed the expense has been incurred. And then to estimate the right profit and loss, I will have to match my income and expense for a particular time period to estimate the correct profit and loss for the business for that particular period. I hope I'm able to make you understand the concept of accounting, which is two very important concepts: one, matching principle, and the other, an accrual principle. Thank you very much. We'll continue discussion in the next session.